and thank you for joining us for today's Academy Sector Focus event. I hope you've all sort of managed to have a decent break over the summer holiday, managed to get away, managed to recharge, managed to refresh, and also managed not to come down with COVID during that time as well. I know talking to a few people in the networking rooms, there's certainly been a few stories of coming home with COVID at the end of the holiday. So I hope you didn't have that, but if you did, I hope you've all recovered and are well and fighting fit for the new academic year. So the last year, it's certainly been an interesting year. Lots of ever-changing sort of sector and environment as ever in education, and I know certainly from talking to a lot of clients so far, and just from talking with the ESFA as well through the forums I'm on, there's a lot of ongoing challenges for schools at the moment. Not just with some of the ongoing COVID challenges, but with the schools bill and the focus on growth and capacity. I know recruitment is really difficult in schools, not just at staff level, trustee level. There's all the inflationary cost pressures from pay increases and increasing energy costs as well. And I'll touch on some of that a little bit later. And the funding position around that and the uncertainty of funding. And I think as well, from talking to a lot of clients, a lot of trusts, there's just this increasing compliance burden as well. Constant changes in handbook, accounts direction, although not too many this year, but there's lots of other bits and pieces of guidance that come out, around particular income streams, around best practice, good practice guides. And also what we're also seeing is, I think as HMRC starts to wake up to this sector, we're starting to see a bit more focus on areas around VAT and employment taxes. And so we've also got some sessions on that for you later today. We can't cover all of those areas, but we have got a bit of a lineup of some speakers today that will hopefully just give you a bit of an update on a few key areas. I'll start off with a little bit of a technical roundup heading into the year end. Some of the key points to note just from the new accounts direction, the new handbook. Very minimal changes there, and also just a recap on some of the key points from last year's handbook, because obviously those will be relevant as we go through this year-end order, and also in terms of your trustees report as well. Glenn, one of the directors in our not-for-profit team, will do a bit of a practical update for you, just things to think about with the year-end, what to expect from us. Some common problem areas that we encounter, and also just a bit of an update on the remote audit process and using inflow, and some good tips and pointers around that. Matthew Blake from our VAT team is going to give a bit of an update about VAT, and again some of the key sort of issues he's seeing, key focus areas from HMRC as well, and just some things that you need to keep a watch out around VAT. And then Nathan Woolery, who is fairly new to Cooper Parry, and he heads up our employment taxes team. So Nathan is going to give a little bit of an update about employment tax, and again, just some of the issues he's seeing as well in the sector, and areas where, again, you might get a little bit of focus from HMRC, or where it might be good practice just to look at what you're doing. That's it. After the first two sessions, we'll have a short coffee break. Then we'll jump into the VAT and employment taxes update, and then we'll have a bit of a Q&A panel at the end, where myself, Glenn, Nathan, and Matt will answer any other questions you've got. But throughout the sessions, if you have got any questions, I'm more than happy to just log those on the chat or the Q&A, and we'll do our best to answer those as we go through. And just a final reminder, when you're back in the rooms, you'll hopefully see on one of the sort of sponsor boards up on the left a feedback form. It'd be really great to get your feedback about the event. just what you thought, how maybe we can improve that, any areas you'd like us to cover in the future. Right, so I guess without any further delay or mucking around, we'll kick into the first session, which is me, and I'm just doing a little bit of an update, a bit of a technical update on a few key areas at the moment. So I'll just share my screen so we can get that going. Okay, so hopefully you've got that there. So yeah, technical update and a few key takeaways. So what I'm going to cover just in this session is a little bit about some of the key assurance outcomes from the ESFA's 2021 assurance program. So that's looking at 2021 year accounts, just some of the key themes that have come out from that, and so some points to consider there. I'll cover the accounts direction that we're going to be working to for this year end, and again, just some of the key changes, and particularly some of the key changes that have a bigger impact on you as you know, as trust CFO, finance directors. I'll then cover off the key changes. When I say key, minimal changes in the very late published 2022 Academy Trust Handbook. I'll do a little bit of a recap of some of the key points from 2021 handbook, because obviously those will be areas that we're certainly covering off in our audit and regularity work as well. So just to highlight some of the key points that may have had an impact this year. And I'll also, I suppose, maybe horizon scan a little bit about what the 2023 handbook might include, given the 2022 one was pretty late, and a lot of things that we hoped to see in there, we didn't. And then a couple of other just sort of good to knows, I guess, couple of updates at the end. So ESFA assurance arrangements. I guess the ESFA, for those that don't know, they sort of look at how do they get assurance over the sector, and they do it in three core areas. They get assurance over funding, over the funding allocated, and they essentially do that through their own funding audits. And I don't know if any of you had funding audits, but essentially they're looking at at the census data and the funding that is driven by that census data. So your dedicated schools grant, the 16 to 19 funding, pupil premium, that sort of stuff. And I don't think there's really too many adverse findings that come out from that work. They then get assurance over the use of funds, and really their key the key area they rely on there is the Academy Trust's audited financial statements, their reviews of those audited financial statements, auditors' management letters, internal scrutiny reports that all get submitted as part of that end of year process. That's probably the key area that they look at, and that's the key bit I'll focus on. They also do a bit of random testing of some specific grant streams themselves. And then they also get assurance over control environment in trusts, which they essentially do through their FMGS reviews. And again, for any trusts that have had FMGS reviews, you know, a lot of the time those focus on new trusts, but then periodically the ESFA will do FMGS reviews at existing trusts, particularly if there's been you know, a lot of changes, or maybe there's been some other issues that the ESFA have got wind about. They may do an FMGS review. In terms of financial statement income outcomes from 2021 year end, I mean, basically 99% of trusts had unqualified audit reports, so that's clean opinions, and that was pretty consistent with prior years. So I think it gives the ESFA a lot of comfort that financial statements, I guess, are true and fair. There's not material accounting or audit issues in those accounts. One thing is, although it doesn't qualify, it doesn't represent a qualified report, there's a lot of in our audit reports often we'll talk about a material uncertainty or an emphasis on matter, and often those are around going concern. And there was still a fairly consistent level of disclosures around going concern. More of those in recent years have been about trusts closing, as there continues to be a lot of consolidation in the sector. More of those disclosures are because a trust is closing and joining another trust or merging with another trust. The number that relate to actual real, I guess, financial concerns in terms of low reserves, financial viability going forward, the number of those have dropped year on year. So I guess looking at last year, perhaps that's a positive outlook. But I think as we look forward to this year, particularly with some of the recent pay announcements, energy costs, I think there's an expectation that perhaps going concern may present more of an issue as we go through the audit this year end. And that will certainly be an area that we have to look at through the audit as well. And we'll certainly be talking to you about your budgets, the forecasts, the assumptions that underpin those, and also looking at how what impact, if they haven't already been factored into those budgets, what impact pay increases, energy cost increases are having on those as well, and how those are going to be, I guess, mitigated or dealt with. And then in terms of the 1% audit reports that have been qualified, to be honest, those have tended to relate to local government pension scheme valuations or FRS 2 valuations, and generally lack of them for some reason, and then also land and building valuations, but it's around 1%. In terms of regularity assurance outcomes, this is I think this is more of a key focus for the SFA, because this is about using funds for the purposes intended, complying with the handbook. And actually the level of qualification here is much higher compared to the financial statements. There we're talking 1%. Here we're talking around about 8% of trusts have a modified or qualified regularity report. Again, fairly consistent year on year. And I've just detailed there what the top regularity issues come from. And so these are, I guess, are really the headlines to think about in your trust, and make sure that these areas you well and truly are complying with and have under control. So the lack of appropriate internal financial reporting, what I mean there is management accounts. The handbook is quite prescriptive about producing monthly management accounts, what those accounts should entail, how they're reported, provided to trustees. So again, from last year, nearly a third of trusts of those regularity qualifications coming from the lack of appropriate management accounts and reporting. The other one is a lack of reporting and or pre-approval around related party transactions. And that's probably the most common issue we found last year as well, through our regularity assurance work. And some of that comes particularly around diocesan transactions, and there's been, I guess, confusion around the guidance on that. So I'll talk about that a little bit later as well. Lack of internal scrutiny or appropriate internal scrutiny is sort of next on the list. And then finally, of the major players is lack of appropriate procurement policies and tendering. And that's really, around ensuring that you are getting best value for money in your procurement process. So, second and third quotes, and following appropriate tendering procedures for large value contracts as well. I think on the internal scrutiny point as well, it's important there, particularly as trusts grow and expand, that some of the older form of internal scrutiny arrangements in terms of possibly peer review or a governor doing it may not be so fit for purpose as a trust grows and expands, and particularly as there's an expectation that internal scrutiny now covers non-financial areas as well. It's important that you're using the right expertise to complete that work. In terms of FMGS outcomes, FMGS reviews outcomes very quickly from the reviews the ESFA do. They've assessed about 93% of trusts having good or satisfactory compliance with the handbook, and the key weaknesses they noted were around internal scrutiny arrangements, particularly the approach and delivery of that, and then also just around the role and remit of the audit committee, and that has been to be fair, I think a confusing area sometimes for a lot of board of trustees, is just about that remit and role of the audit committee, and especially where it's not a separate committee, it's part of your finance committee. Right, so that was just a brief outline of ESFA assurance outcomes. Accounts direction. So the new accounts direction published earlier this year, this applies to the 31st of August 22 period end or year end. So to be honest, there wasn't massive changes in this. There's a couple of new requirements, some clarifications around some specific accounting areas and treatments, and also some common areas of non-compliance, which is probably the key point to outline. In terms of the new requirements, there's just some additional disclosures around severance payments and putting severance payments into specific bandings. Previously, you just disclosed the total, whereas you now have to put them into some specific bandings. And there's also the continuing disclosure about special severance payments, i.e. non-contractual payments, having to detail the individual amounts of those as well. So the main change there is just the disclosures in bandings that you'll see. This is probably the next point, is probably the key change really in the accounts direction this year, which is in the governance statement. You now have to disclose how the trust manages its conflicts of interest. So conflicts of interest, it is a bit of a hot topic in the sector, particularly given ongoing related party transaction issues, and just generally concerns around that in the sector. So what you have to disclose, what the ESFA are looking for trusts to talk about in disclosing their conflicts of interest is, do they have a conflicts of interest policy? How do they operate that? Is a register of interest maintained? How's that register of interest used to control or deal with conflicts of interests? How are they avoided? And just generally, what is the process that's adopted by the trust? What does best practice look like around? Sorry, I've gone off. What does best practice look like around a conflicts of interest policy? Well, I mean, the NGA have a good example on their website of a conflicts of interest policy, but I think in terms of good practice, what you want to do is make sure that you do have a conflicts of interest policy, that that it is published, and that it is communicated widely across the organisation. I know some trusts also have an annual code of conduct that all trustees, senior leaders sign up to as well, which obviously embodies that whole conflicts of interest policy. So that may be something that you can look at incorporating. Then it's having a register of interest that capture all relevant business pecuniary interests, and also that register is updated regularly. It's not a once a year document anymore. The emphasis is very much that is updated regularly, and that's where you've got new trustees or trustees leaving, or maybe where you've got new schools joining the trust, changes in local governing bodies even. It should be a really, a living register. And then what are the processes around once you've got that register of interest that's very visible through the organisation, through the finance team, so they know and are able to capture any transactions that might arise coming out of those interests, and ensure they're all undertaken in accordance with the handbook. And I think as well, given the focus on this, probably something that you may need to think about going forward is just what kind of assurance you get around your conflict of interest and managing that. And maybe an area that internal audit, internal assurance can look at in the future. There's also a really helpful charity commission, some charity commission guidance on conflicts of interest. It's called CC29, a guide for charity trustees, and that's certainly some really useful guidance to look at. In terms of clarifications, probably the main clarification in the trustee report is when you come to talking about the organisational structure, and particularly trusts that have any trading subsidiaries or joint ventures and associates. It's important that your description of the organisational structure talks about those, how those are controlled, again, any conflicts of interest that might arise with those, and just how those are incorporated into the overall sort of trust activity. In terms of notes to the accounts, I won't dwell on these too much because obviously we'll be preparing the accounts for you, so we'll ensure that the disclosures in these areas are certainly up to scratch. But again, some minor clarifications around something called service concession arrangements, or otherwise known as PFI arrangements, just around how those should be disclosed depending on whether the trust is an actual party to the contract or more a third party. So it's about whether they sit on the balance sheet, the land and buildings under those PFI arrangements, or whether they sit off the balance sheet and are then disclosed as commitments. And for those of you that have teaching schools, the good news is that there's now no longer a separate teaching school account required. So some of you may be ecstatic about that, some may be disappointed. It can still be incorporated if it's something that's useful in the accounts, but it won't be a separate statement. It will just be included in the principal SOFA documents where it's considered material. In terms of accounting treatments, again, some minor clarifications around buildings being built and funded by the DfE under their free schools or priority schools building program, just about how those should be treated, and essentially that particularly where the DfE is building and funding those directly themselves, so it's all off balance sheet. Basically, those shouldn't be recognised as assets until they're handed over from the DfE. Some priority school building projects, the funding does come direct from the DfE to the trust to then obviously contract directly with the contractors to build it. So in that case, that's different. And then also just around business rates, expenditure and funding. This year, obviously, there's a change of process with local authorities. Not all local authorities have adopted into this new regime, but where they have, basically the local authorities will be being paid the relevant rates directly by the ESFA. The ESFA will deduct those off your GAG funding, so there does need to be a grossing exercise in the accounts for the expenditure and funding. Doesn't have any impact on the bottom line, similar to before where you paid the rates direct and reclaimed it back. The gross expenditure and funding was disclosed in the accounts. But again, we'll talk that through with you as part of the year-end audit process. One bit I really wanted to cover was just around common areas of non-compliance with the AAD. And this is a really helpful piece that the SFA have included in the accounts direction the last couple of years. From their own reviews, they've just, I guess, flagged and highlighted areas where trusts aren't complying with the AAD. And I think the real key message out of the feedback they've provided this year is really about trusts, trustees report and governance statement not being too boilerplate. A lot of trusts, in their view, is a lot of trusts that are really just copying across text from Coketown, putting it into their report, governance statements, and it's not really reflecting what the story is of the trust. So if they're if the management letter or audit report or regularity report is highlighting perhaps some some real financial control issues, but then the governance statement is all talking about robust procedures and things like that, it's a bit conflicting. Also just boilerplate statements about internal scrutiny program not really reflecting what you've actually had done in the year, and just other sort of boilerplate statements about organizational structure, governance structure. So I think what the SFA are really stressing is that it should be I guess really a living document and tell the story of your trust, not the story of Coketown. So it will need careful thought, it will need editing. And I think as well with this is that there's a lot of information that the SFA now have around trusts. There's not just the trustees report, they get the internal scrutiny reports, they get management letters, there are notices to improve, there are their FMGS reviews, there are SRMA reports, and they do the related party transactions notifications as well. So they do a lot of checking and cross-referencing, and this is where they pick up that actually there's a lot of inconsistencies and things like internal scrutiny reports may have covered off a governance review and HR review, but then the governance statement is talking about the internal scrutiny having reviewed estates and premises, for example. So they're just picking up these conflicts of information that they've got. The other area of non-compliance with the AOD, again, it's kind of in the trustees and governance statement, is that there are some areas of specific musts, particularly in the governance statement, and that's talking about how you assess the effectiveness of the trust governance, particularly doing governance reviews, or if you haven't done governance reviews, why is that, and when is the next one going to be done? If you've had less than 6 trustee meetings in the year, how do you maintain effective oversight? You must talk about that. And also you must talk about your internal scrutiny arrangements, the scope of work that's been undertaken, what are the findings from that work, are there any significant remedial issues that have to be dealt with? And again, in a lot of those areas, trustee reports have been I guess lacking, not really detailing the information that needs to be detailed there. And then a small point, a trustee remuneration disclosure in the accounts, sometimes not picking up and disclosing the actual names of individuals and the remuneration bandings as required. So I guess from all of that, as you'll see, the real emphasis was around trustees reports. And I guess my key tips here for writing it is, start early, don't leave it to the last minute. Understand the timing around when your auditors or us are going to require that and what needs to go into that. And I think as well, just it's not the CFO's report, it's not the accounting officer's report, it is a trustee's report. So it is really important to ensure that there is involvement from the trustees and that is built into the whole review plan, and that's built into the review of that document before it's provided to us to I guess incorporate into the financial statements, and ensure that it correlates with all that other information and really tells the story of your trust. Right. Time, I'm doing okay, I think. Right, the 2022 handbook. Yeah, we weren't sure we were going to get there with it, whether this was actually going to be published before the 1st of September, but it was a whole 7 days before the start of the new academic year. But a relief was that there are really only minimal changes. There's a useful schedule of musts again at the end of it, and there's pretty much the same number of musts as before. And I think around those musts, just again something that you can build into your internal scrutiny program or doing your own self-reviews is just working through those schedule of musts and ensuring that your trust continues to comply with those. So in terms of the key changes, well, you'll see here they're really minimal. They removed the requirement to submit a BFRO. We already knew that, but they've just obviously embodied that in the handbook. Provided a bit of clarity around special severance payments, and which is in line with the guidance that the Treasury issued last year, but just clarifying where you need pre-approval around special severance payments. And when I mean special, I mean non-contractual, non-statutory. So there are the pre-approved limits, and then there's also the higher value exit packages over 100,000, or for anyone earning more than 150,000, where those include any element of a special payment as well. The interesting one is a clarification around indemnities. Previously, trusts had to seek ESFA approval before entering into any indemnity, which was a bit prohibitive. So they've now, I guess, clarified that and said that it's pre-approval isn't needed where the indemnity is entered into in the normal course of business. So that could be a catering contract, a land and building contract, SLA with a trading company, where there'll normally be an indemnity within the contract, but that is a normal part of business. You won't need to get the ESFA approval. I think something important here is the ESFA have said that their expectation, inverted commas, is that trusts maintain a register of indemnities. What we've seen in the past is expectation soonly moves into must. So I would certainly, along with having a register of interests and register of contracts, be recommending that you start pulling together or looking at register of indemnities and any indemnities that are in any contracts that you have signed up to. And then the very last point is again a little bit of clarification about transactions with dioceses. All transactions with dioceses that were around the ensuring the religious ethos and character of a school or trust were deemed to be at cost under the handbook. This has now just been extended to all trusts of a religious designation rather than just the diocese. I think the important thing to remember there is, although it's deemed at cost, it doesn't remove the requirement to still be reporting transactions like this where they are a related party transaction to the ESFA. And that's been one of the sort of common regularity issues we've seen recently as well, where often some trusts were seeing that it's deemed at cost and taking that as, well, we don't need to notify or report that to the SFA. It's still a related party transaction, so it still needs to be reported, if that makes sense. Right, what to expect next year? I'm a little bit restricted in exactly what I can and can't say around this. Just because of the forums and groups I'm on. But I guess it's suffice to say that there are a few things that we'd hope to see in the new handbook this year that weren't included. So I think the expectation is probably that those will be incorporated into the new handbook. I think from what I've seen and understand, I think what the focus of some of these will be some continuing focus around governance, and particularly, I guess, when you think about the schools bill and the direction of that around strong growing trusts, 10 schools at least, there's going to be a focus on governance, I think, again, and particularly around boards having sufficient financial knowledge, sufficient expertise on their boards, and emphasising the suitability checks around chairs of trustees and differentiation between accounting officer and CFO, and that these can't be the same person in some cases. So I guess that's where I'd expect some increased emphasis. And also leasing. There is a separate, I guess, group looking at leasing at the moment, because obviously trusts can't enter into any finance leases, and that does throw up some potential issues, particularly around catering contracts and things like that. that is being looked at under the new handbook as well. And then also, I guess it depends what impact the schools bill, once that is gone through its regulatory review and rewritten, how that might translate into handbook, particularly around some of the I guess the what they're trying to do with that schools bill is of having a new framework of authorities and rules. I've included there in the notes, I'm probably running a bit short of time, just some quick recaps from last year's handbook. I won't go all through these, but I've just highlighted in bold. We'll send these slides out after, but just some of the, I guess, key points to remember from last year's handbook, because obviously it will be relevant this year. So a key point there was that from March this year, sorry, any newly appointed senior executive leaders or accounting officers can only be appointed a trustee if the articles permit it, and also that they agree to it and the members approve it. So just something to watch out there, that you haven't inadvertently breached that during the emphasis around chairs of trustees shouldn't also be chairs of audit committee, so making sure that you haven't had some arrangement like that in place, and also where your audit and finance committees are separate, also the same person shouldn't be chairing those committees. Ensuring that you've approved a written scheme of delegation through the year, and also that has been reviewed annually through the year as well, depending on whether you've had particular significant changes in your trust. A reminder about off-payroll arrangements, particularly around CFO, accounting officer, where any of those are off payroll, making sure that those are included in the executive pay on the trust website, and also we have to incorporate that into the accounts. Reminder there as well, just about employee exit payments, and again, just the change last year that was brought in around those higher value exit payments. Again, we will pick that up through the course of the audit as well. Cybercrime has obviously been a topical issue, so again, just making sure that you have appropriate policies, controls, procedures in place around that, and have maintained that through the year. And also, if any of you were, I know from talking to clients, luckily none that I've spoken to have had this, but if you have had any ransom demands, you had to obtain ESFA approval around those. So that was a real quick whistle stop. The last bit, just sort of what's new. It was kind of hard. Where do I start and finish with this? So I just thought of some really topical things. Obviously, the schools bill, as I said earlier, it's going through regulatory review at the moment, which should finish by the end of this year. I think that the theme from it is that this common rule book of minimum standards is probably still likely, but it just depends what shape that will take. And obviously the first drafting of that in the schools bill was pretty much thrown out. But I think the emphasis is clearly continuing to work to full academisation by 2030, as the white paper had suggested. And the development of strong trusts of at least 10 schools or 7,500 pupils. So I think it's important that you trusts do have a strategic plan about how you are going to work towards that, because that is going to be, I guess, the emphasis from the DFE over the coming years. Energy cost guarantee. I've had a few questions about this following on from the announcements about the guarantee for schools. Unfortunately, not much I can really say, because there's no real details around this as to what shape it will take, that guarantee. In terms of just what does it mean? Is it guaranteeing current rates? Is it guaranteeing previous rates? Is it also guaranteeing a fixed amount? That's there's just not the details. So I think we just have to wait to find out exactly what that means. All the government has said is it's a 6-month guarantee, and then after that they will look at vulnerable industries sectors to look at what other support they can provide. Pay increases, obviously there's support staff pay increases haven't yet been agreed, and there's also some ongoing deliberation around some of the teacher pay increases and the starting teacher salaries. So those have clearly had a big impact on budgets from when they were announced, and particularly budgets that had already been submitted. And I know from talking to trusts that some of these factors, energy costs and pay increases, are having an impact on budgets of anywhere from a couple of $100,000, upward to talking to one trust yesterday where the impact of these two is probably having an impact of about £750,000 across the trust. And in terms of funding, there's no announcements that I'm aware of seen around funding for those. I think there's a lot of pressure in the sector that will come to bear around that. So it's a bit of a watch this space. And the very last thing, LGPS, the actuaries are currently or about to start, I think, their sort of 3-year valuation of local government pension scheme. We had a bit of an update from the actuaries last week in terms of 2 things. One is looking forward to your FRS 102 reports. I know no one pays a lot of interest to FRS 102 reports in the accounts, but there will be some good news because of the investment markets, but also the increase in discount rates. The deficits will be coming down quite significantly when you get those FRS 102 reports this year. So hopefully that will. I know some trustees get quite concerned about LGPS deficits in the accounts, so hopefully they'll see those coming down. That doesn't necessarily mean contribution rates will be coming down, because that's a completely different exercise. And I think the early indication from the actuaries of the valuation exercise that they will do at March, which will drive contribution rates from April 2023, is that there'll be some relatively small increases. I think is generally what the actuaries were saying.
So Andy's been through all the technical updates, and my slots here is very much just to go through some of the practicalities. So things you can think about, what you can expect from us, how can we make sure that this year-end audit for the 31st of August 22 is as smooth as possible. I'm going to share my screen. So what I'm going to cover, four main areas. So first of all, a bit of a pre-audit health check. So things that you can be doing before the audit gets going in earnest, things you can look at just to make sure that you're in the best place you can be for that audit, and that you're happy that all those figures that are coming over to us and the information is up to date. A bit like Andy went through the ESFA's sort of review of last year, I'm going to do a very quick run through of some of the common MLPs, the management letter points that we included in our Academy Trust last year, all anonymous, so nobody needs to worry. But some of the things that we saw sort of more often than not. And a lot of these are very much sort of minor points as well. So things that with a bit of sort of pre-warning, with a little bit of pre-work being done now, we can hopefully avoid having some of those points included on your management letters at the end of the audit. Quick section on what you can expect from us. So what you'll hear from us in terms of the planning and in terms of the audit field work and what you're going to get from us at the end. And then a quick update on Inflow, which if you were a client of ours last year, we would have used Inflow for our audit deliverables. We're still continuing with Inflow, which I think the majority will think is really good news, because we got some great feedback on that last year. But a few improvements and a bit of a refresher, which I'll cover off on my session. So in terms of a pre-audit health check, so what can you do now so that when you send over those first draft accounts or draft trial balance, to make sure that it is sort of ready for audit, that there's no sort of obvious glaring errors within there. So these are things that you can be doing. I mean, a lot of you will already have done them sort of over the summer or before the summer, but things that if you can get these done, And if all these things are addressed before they come to us, then it will make that audit process much smoother. So first of all is just checking your opening balances within your account system. And the easiest way to do that is to run your trial balance, have a look at those opening reserves, and they should match up to what you've got in those signed financial statements from the 31st of August 2021. If they agree in total, that's brilliant. It means that any sort of final journals, any audit adjustments included were posted in there. If they don't agree, then it may be something worth having a look at before you send that trial balance over to us. It could be that year-end journals weren't posted last year, or it could be that you've made some missed postings perhaps during the current year into those reserve accounts, into those fund accounts. So just worth having a look to make sure those opening balances do agree. Then in terms of sort of the 31st of August 22 balances, it's a case of checking your control accounts and making sure that what you've got in your various accounts do match up to what you've got on that trial balance. Things like your bank reconciliations, if they've been done up to 31st of August and do they agree? So that reconciliation between what's on your bank statement versus what's your trial balance figure. Look at payroll. So typically we would expect sort of the August payroll, the PAYE, the NI, and the pension payments for that final month to be a creditor at the 31st of August, unless you've paid them before that date. So just making sure that they do match up to that final month's payroll. Looking at VAT, so whether you're registered for VAT and do returns, or whether you're doing the old VAT 126 forms, making sure that what you've then got again as that final debtor or creditor in your trial balance, does it match up to any outstanding returns that you're awaiting payment as at the 31st of August. And then prepayments and accruals, where you keep a separate control account or keep a spreadsheet of those prepayments and accruals. Does that total at 31st of August match up to what you've got in that trial balance figure? So very much just making sure all of those control accounts that you operate and reconcile on a monthly basis, do they all agree as at August? And if they do all agree, then excellent, and that makes sure that we'll have a nice straightforward audit, particularly around those areas. I've then got the fixed asset register on there as a separate point, because this is one that typically we tend to see if there are sort of differences or where there are differences, it takes a bit longer to sort of unravel them and to reconcile. Got some suggestions here of things that can be done before the audit starts again, but particularly around the fixed asset register. So the obvious one there, much like the other control accounts, is does that fixed asset register agree to your trial balance? So taking each of the categories of assets that you hold, whether that's the land and buildings, your IT equipment, fixtures and fittings, do the cost and the depreciation totals match what you've got in your trial balance. So then if those two match, then the net book value will agree. But also looking at the opening cost and depreciation, where you've got your fixed asset register, however you're maintaining that, do the opening values agree back to those August 21 accounts? So we're starting from the same position. Question around, have all your capital additions been added to the register? So anything that you've purchased during the year that's a fixed asset. And bearing in mind here is that in accordance with your accounting policy. So where you've got a sort of de minimis limit of over that threshold is what you do capitalize. Have the additions that you've put on the register, do they adhere to that policy, or have you capitalized more than you perhaps should have? In which case, should they be on that register in the first place? And if you've got any additions above that threshold, making sure that they are on that register. And then reviewing sort of your other expenditure nominal ledgers for the year for any further capital items that may meet that accounting policy, but perhaps haven't been included on the register. And that's, without giving it away, that's one of the tests that we do during our audit. And we will have a look through your expenditure, through your revenue expenditure, and look for items that potentially are capital in nature, in question. If they're not included on your fixed asset register, then why not? So get ahead of the game and you can have a look through those. Review the depreciation. So have you applied the depreciation rates in accordance with the accounting policy? So where you've got a 33% straight line policy for IT equipment as an example, is that what your fixed asset register actually shows? Check those formulas within there, make sure it's been applied correctly. And then where you've calculated the depreciation, has that then been journaled into your accounting system? But that will come out in that top point about making sure your fixed asset register reconciles to your trial balance. And then a point that often gets missed is whether there's any fixed asset disposals in the year that need to be actioned. So this could be that you've sold some assets during the year, in which case you need to make sure they're removed from the fixed asset register. Potentially some additions, if you've got some new IT equipment or new fixtures, new desk chairs that have come in during the year. Has that resulted in some old ones then being disposed of? In which case, have you removed the old ones from the fixed asset register? And then this is one that we quite often bring up as a management letter point, and I'll go into a bit more detail later, around where you've got a lot of assets that were purchased many, many years ago. Per the accounting policy, they've been fully depreciated, they've got nil net book value. Having a review of those and seeing if they are still in use. So if you do still hold the assets and are being used, then yes, they can stay in the fixed asset register. But if they're old assets and they've potentially been scrapped now, or are no longer in use, then consider removing them, just to keep that fixed asset register manageable and have it just assets that are actually being used. Moving away from the balance sheet, so now looking more at the income in particular. For your main funding streams, I'm thinking sort of the main large funding that comes in from the ESFA, largest one obviously being your general annual grant. Almost bringing up the trial balance, looking at that income section and just going down line by line and doing a bit of a sense check on each one. So is the values that you've got in there for your GAG income, does that match up to the funding confirmation that you've had for the year? For your other ESFA or DFE grants that you get, so things like pupil premium, the supplementary grant that we've got this year, or the other grants, just having a look at those figures and are they in line with what you expect them to be? Things like the pupil premium, obviously affected by accrued income at the end of the year. So it doesn't look like you've got 12 months worth of pupil premium being recognised in those accounts in that trial balance, and just having a review and making sure that looks sensible. And then where you get local authority funding as well, if you get any additional SEN funding or some early years funding, making sure again that those funding totals look sensible, that there's nothing unusual within there, just as a bit of a sense check. And then capital funding's always worth checking as well. So whether you've got the DFC income or the SCA, again, what you've got in that trial balance, is it in line with what you know you've received as part of that capital funding for the year? And one where we see quite a lot of audit adjustments is around the condition improvement fund. So where you've had successful SIF bids during the year, have you recognised all of that income once it's been awarded? So have you accrued the income that you haven't yet received? Making sure that's in there and that's complete. But also revisiting any SIF bids from the year before. So where you did accrue that income in the previous year, has that accrued income been reversed this year, so that you're not double recognising it? Making sure that accrual is reversed. And it's also worth checking where you've got those SIF bids and the projects have now been completed, having a look where the outcome was on that. Did you spend all of the funding? Was there any underspend? And if so, what are you doing with that underspend? Is there any potential clawback from the ESFA for any unspent funding? In terms of getting sort of key dates in diaries, so timetable, it's obviously a tight period, getting those accounts filed by the 31st of December with the ESFA. So making sure before we have our planning meetings that you've got the audit and finance committee meeting dates, you know when they are, you know when the full board meeting is, when those accounts are actually being approved and signed. Audit planning and completion meetings with us as auditors. A lot of planning meetings I know have already taken place or are in the diary, and if they're not, they will be very, very soon. And also the audit fieldwork dates, so you know when we will be undertaking that audit work, and another one in there, I guess, is the deliverables, when we need all of your information to be provided. As Andy said earlier, for the majority of you, we do also sort of prepare those statutory accounts as well. But for those that I know there are a few on the call who prepare their own accounts, you can start rolling forward those this year. And he's been through some of the updates in the accounts direction this year, not too many, thankfully, but make sure that those ones that have been discussed are incorporated into that template for this year. The trustees report, Andy's already mentioned about the changes within there, and have you started yet? Make sure there is a timetable in place to pull that together. And again, those updates that Andy mentioned, make sure that they are included. And in terms of getting ready for the audit, again, just some of the governance information, some of that additional information that goes into the accounts can be pulled together. So in terms of members and governors, you've got a list of who any changes that have happened during the year, what date they were appointed, dates of resignations, and a reminder that goes from sort of the beginning of the last financial year, so from the 1st of September 21, and that's going all the way up to the date that the accounts are signed. So any changes between now and if the accounts are signed in December, between now and December also need to be reflected in that governance information. Any changes in your professional advisors, so any changes in auditor or solicitors or bankers need to be included there. You need to add up all the meeting attendance for the full board, and also any audit committee or finance committee that you disclose in the governance statement. So that information can start being pulled together. The value for money statement needs updating in the governance statement, and then internal assurance as well. Again, as Andy mentioned earlier, one of the points from the ESFA was around making sure that is specific to the trust and not just copying what's included in the Coketown accounts. It needs to tell your story and what you've done as part of that internal assurance. In terms of audit deliverables, I mentioned we're using inflow again, and for a lot of trusts, again, the inflow's been set up. You should have access to it, so by all means go in there if you haven't already, start reviewing what's been requested, and make sure you're familiar with what it is we're asking for. And I guess the good news is there aren't that many changes to the AAD this year, which also means there's not much changes to what we need to audit this year. So in terms of what we're requesting and the information we need, it is broadly similar to the prior year. So if you've been through that process with us before, then it should be very similar this year. Think about whether things are available electronically. I know a lot of you now, all of your information is available electronically, which makes that uploading a lot simpler. But if you've got some things that are still very much paper-based, then I think, is it something that you need to put time aside to scan in, or is it something that you need us to come out on site for part of the audit to review and test that area? And those sort of discussions can be had during those planning meetings, just to make sure that the audit can work well for you and for us. If there's anything that can start to be uploaded now, so any board minutes, internal assurance reports are obvious ones, they can be uploaded. And also have a think about what information needs to come from third parties, from other people. So declarations of interest, making sure that all trustees have provided those and they're up to date, chasing any stragglers that perhaps haven't been received yet. Local government pension scheme valuation, again, Andy mentioned earlier, making sure that the actuaries know that we require one for the year end, make sure the instructions have been delivered, which I know for a lot of them were done a while ago now. So if you haven't heard from them, get in touch, because we will need those for the accounts. And then land and building valuations, we've got on there as well, but that's mainly for where you've got new converters or new schools coming in and you need that valuation. Going concern, again, Andy mentioned earlier, it's very much a hot topic and will be a key audit risk for us this year. And we're looking not just at 22-23, so not just the next financial year, but the going concern conclusion that the trustees sign off on, and then we as auditors then sign off on. It's at least 12 months from the date the accounts are signed. So we're looking to at least December 23. But I know with all the budget forecast return submissions, you look at 3 years as a minimum anyway. But making sure that they're available, they can be uploaded, they're part of the deliverables that we request. And as Andy said, we will be reviewing these in a lot of detail, particularly looking around some of your key assumptions around the pay review. Especially, Tom, as you mentioned, that there's not going to be any additional funding for that. And then energy costs and the sort of increasing costs that we're seeing everywhere, making sure that they are included in those budgets that have been prepared and approved by the board. Just going to talk about some of the common MLPs that we had last year. Those who are audit clients last year will recognise that table. So where we have recommendations from the audit in terms of improvements in control or systems, then we grade them red, amber, green, and then also revisit any points from the year before to see if they've been addressed. And so I've got 6 here as just common MLPs of things that we put in a number of reports last year. So things to look at and address and make sure that you're not going to fall into that category, I guess. Fixed asset registers, making sure they are kept up to date throughout the year, make sure that they do agree to that trial balance. Declarations of interest. So again, make sure that you've traced in all of those declarations of interest, make sure your register's up to date. But then also reviewing those to make sure that there's no other interests that haven't been declared on the forms. A simple test that we do as part of the audit is just look at the public register for Companies House and for the Charity Commission to see if there are any other directorships or trusteeships that the board hold. So a simple check that can be done by yourselves just to make sure that there aren't any sort of undeclared items that we then pick up during the audit work. One here is around sort of your sales ledger and purchase ledger, and more just doing a bit of a health check on that. So where you've got any older balances, so things that have sat on the ledger for 3 months plus, we think that tends to be a little bit unusual. So do they need writing off? Are they sort of an incorrect balance that's on there? So exploring those, understanding what they are, and then making those adjustments before they come through to us. And then also on your sales and purchase ledgers, if you've got some balances on there which are the wrong way. So on your sales ledger, you'd expect it to be people that owe you money. If you've got any credit balances on there, then that tends to be unusual. It could be that there's sort of been an overpayment at some point or a credit note applied, but worth reviewing those and understanding the reasons for it. And again, if they need tidying up, then just tidying up before it comes to us. Employment records is one that we saw on a few trusts last year. So either employment contracts or signed employment contracts not being held for the staff that we selected for our audit testing. And also no documentation on those staff files about evidence and any changes in pay that have happened over the last year. So just confirming that the level of pay that a staff member receives, is there something confirming that on the file? Related party transactions, again, Andy spoke about this one from a regularity point of view. And as he said, where we had regularity breaches, it was more often than not around the related party transactions. And these are not reporting to ESFA in accordance with the trust handbook requirements, particularly around, as Andy mentioned again, the diocese transactions that happen with the church schools. And then there was the odd occasion as well. There wasn't prior approval being obtained where they'd gone over the thresholds for some of the transactions as well. But where they were management letter points, there were also regularity issues. So something that needs to be looked at. And then capital funds. So this is primarily around the SIF bids again. So having a good control account and understanding what income you've had in, what's been spent, and any balances that are being carried forward at that end of the year. What can you expect from us? So audit planning meetings. I said a lot of these have already taken place. If they haven't, they're in the diary, and if they're not, they will be extremely soon. So that's an opportunity to meet with you, discuss the specific situation for you and your trust, discuss the audit timetable, what needs to be delivered, when it needs to be delivered, and any particular accounting issues you've got on during the year, and really just get everything out from both sides in terms of what needs to be done to make sure that we do hit those all-important deadlines and sign-off dates for your accounts and audit. We'll then issue an audit planning report, which will set out everything from that meeting. So what are the key audit risks? What's our audit approach to those risks? The timetable in terms of when things need to be completed by, and then who the audit team is. So you'll know sort of who you need to liaise with, contact details, so we can keep in touch during the audit. We are issuing again trustees report guidance this year. So a report, as we've done in previous years, which gives some background to the changes in the trustees report, a bit of support to help you with writing that report and making sure that you are covering all those sort of key compliance points that the ESFA want you to include. And then the audit deliverables. So we will be using inflow again. So inflow. Appreciate this is probably extremely small on your screen. You can make it slightly bigger with the outward arrows in the top right corner. But just as a bit of a recap, so we used inflow last year, and so the majority of trusts were very happy with that. We certainly were. Thought it was a really good way of managing and controlling those deliverables and our requests. And the screen there, if you've seen it before, you'll recognise it. We have all of our all of the deliverables listed down this left-hand side, and then these blue circles that we've got. The first column lets you know who from our side has requested that information, and the middle one is who from your side needs to respond to that information. And we'll discuss at the planning stage with you if they need to be allocated to different people. But it's also something that you can do yourselves on the request. Is if it comes into somebody and you think it's actually somebody else that deals with that, you can then change that. And then the due date is this green one on the final date, explaining when we need that information by. And in terms of the tables and graphs, I mean, this one is a new one. So this first column shows that a request has been raised and delivered to you. Once you've started working on it, it moves into the next column. Once you've completed it and submitted it back to us, it moves to the third column. And then once we've reviewed it, ticked it off and said, yep, this is what we need, it answers all our queries, then it turns to green right at the end and complete. And the idea is that by the end of the audit, all of these requests have gone all the way over to the other side of the chart. We asked for feedback from everybody last year after the inflow, or particularly on inflow. And we've incorporated some of those requests this year as well. So within the actual requests themselves, We've added some commentary to each of them, or amended the commentary, which gives a bit more detail about what it is that we're requesting. Because some people said the terminology that we use might be slightly different to terminology that's used in the trust. So hopefully made it a lot clearer in terms of what it is that we're requiring. This is the screen for the actual requests. So you're able to add comments between client and audit team in terms of any comments on what's been requested or what we need, or explaining things in more detail. The middle section is for the files, where you can drop in the documents, and that takes any document. So it'd be a Word document, an Excel document, a PDF. They can just drag and drop in there from your records. Something that's really important is once you've uploaded a file into there or added a comment, you need to click this Submit to Engagement Team button that's in the bottom corner. There are a couple of instances where clients had thought they'd uploaded the information. We still hadn't received it because we can't see what you've uploaded until that Submit button is clicked. So just a reminder that when you do upload something, once you've pulled it all together, do make sure it is submitted over to us. So clicking that Submit button then brings up this screen. And again, another point we learned from last year is once things are being uploaded, or once we're raising requests from you, once you get this option, once you get to this stage, there is an option to email as well as send, sort of upload it on Inflow. And we found some people send an email for every single request, and that does mean that you get quite a lot of emails if there's a lot of requests that are being answered to. So we would say if you're going through the deliverables and you're uploading a lot of information, perhaps just send the one request, the one submission by email, and then don't tick the box for the other ones. Because then we'll just get the one email. We can sit and log into Inflow and see lots of things have been uploaded. And similarly, the other way as well. We won't tick that box to email you every time a deliverable is uploaded for you. But we will make sure that if there's a bulk load that are being done, we'll drop you a note just explaining that, yes, we've asked for more information. Please, can you log in and have a look?
Okay, so as you can see from there, my name is Matt Blake, and I'm a senior manager in the VAT team at Cooper Parry. Obviously, I appreciate that VAT isn't everybody's favourite subject. In fact, it's not every VAT practitioner's favourite subject. So I'm going to try not to overwhelm you too much with any sort of in-depth VAT weirdness. So what I'm going to be talking to you about today is a reminder of some of the key VAT issues affecting academies, talking about some recent developments which may impact you, and, you know, in keeping with the theme of getting ready for your audit, discussing how these points could potentially interact with your audit, and how to prepare for your audit from a VAT perspective. I think one thing that's always been very clear from working with academies over the years is that while there are some common themes, no two academies are the same, and almost all have their own sort of little anomaly. And, you know, that's to be expected, as, you know, the academy sector, you know, ranges from single site, relatively small school to, you know, sort of enormous multi-academy trusts. As Steve said at the beginning, if you have any questions, please drop them in the chat, or I'm happy for you to contact me after the event. It's always a little bit harder doing these online events, because quite often if I'm in the room doing a presentation, I'd be looking around, looking out for that person who's all the colours draining out of their face, or furiously writing notes down when I've said something. So you think, okay, need to go and speak to them about slide 4. But obviously we don't have that this time. So if you've got any questions, drop them in the chat. Okay, I mean, this is going to be just a reminder for many of you, but it's worth repeating these sort of key VAT points for academies, particularly because they're kind of relevant to what I'm saying later. So just a little bit of a reminder. So as we know, academies can reclaim VAT incurred on their non-business activities under the Section 33B of the VAT Act scheme. Like most VAT schemes that are described as a simplification, there's actually quite a lot to them and can be potentially complicated. But it does put academies in an unusual situation, as under the normal VAT rules, you can't recover any VAT unless it's incurred in the course of a business activity. And again, normally there's no mechanism for non-VAT registered entities to recover anything at all. So the first stage in that, and this is going to be a recurring theme of this presentation today, is that the procedure requires an apportionment to be made between the Academy's business and non-business activities. The VAT attributable to non-business activities can be reclaimed, but an Academy that isn't VAT registered can't reclaim any of the VAT that's incurred on business activities. If the Academy is VAT registered, it can reclaim some of the VAT on business activities, but there still needs to be a business, non-business apportionment made, because the first step before you do a partial exemption calculation is still that business, non-business apportionment. And that's something that sometimes gets forgotten. So you do business, non-business apportionment, then the business activity goes into your partial exemption calculation, and then you're considering the VAT liabilities of those business activities. Sorry, that's the wrong slide, isn't it? Bear with. Sorry. Got a bit ahead of myself with the slides there. So also Academies, as they generally have charitable status, there are a number of charitable reliefs for VAT purposes, the most significant being the availability of zero rating on new build. And you know, the land and premises are usually the biggest VAT bearing expense. Now this zero rating is available where the building is used solely for non-business use. But obviously being VAT solely doesn't mean solely, it means kind of nearly solely. That being taken to being sort of 95% use for non-business activities. So in addition to their sort of reclaim procedure, Academies also need to think about their business and non-business activities in the context of individual buildings. If there's a change of use in the buildings that you have received under a zero rated relief, then there are clawback provisions. So you need to monitor that use of the building for 10 years. While I wouldn't expect VAT to be the main driver in an Academy's activities, it's just one of those things that must be borne in mind, that if the use of the building evolves, there may be an associated VAT cost. So, seen this slide before, but we'll go over it again. So the key things to think about in what can lead to a change of use. Most Academies do some kind of letting of sort of sports facilities or rooms, and it's quite often part of the sort of community engagement aims. So a change in the level of lettings of a building can have a change of use. Subcontracting activities that would be non-business if carried out by the Academy, but not when provided by a commercial supplier, can also change that business, non-business use. So an example of this that we have seen is catering, which is supplied for pupils, is a non-business activity when supplied by the Academy itself. But we have seen arrangements where the Academy essentially just leased the dining areas and kitchens to a commercial provider, and that commercial provider supplied the catering as principal. So, I mean, the Academy, there was catering provided at the Academy, but the activity of the Academy was leasing property, which is a business activity. They themselves weren't supplying the catering. So it's possible to use outside caterers and still make the supply as principal, but it's one of those things, if you're bringing other people in, then you do need to make sure that the contracts accurately reflect the nature of the supply and who is actually making those supplies. Consultancy income, you know, a lot of the senior leadership team from high performing Academies generate income from assisting other Academies, and so that activity needs to to be looked at. On occasions, I mean, this can fall within the VAT exemptions for education, but it isn't always the case. And it's one of those kind of areas where it's very easy for a kind of spike in use, which is potentially taxable or taxable business activity. So you just need to be aware of that as it develops. Yep, and the other thing I wanted to mention, the change of business activity or business use is if we have a trading subsidiary operating from the academy, that is in business. And so the sort of relationship or lease agreements between the academy and its trading subsidiary may sort of impact on the business, non-business apportionment of that building. So in summary on this kind of point, the academies are always having to make apportionments between business and non-business use, and the VAT registered academies between taxable and VAT exempt supplies. And this needs to be kept under review, really. And the important thing to remember is that while many academies do in the end get to a place of recovering the majority of the VAT they incur, this can't be taken for granted, and the sort of decision-making process does need to be documented. So when Andy or Glenn ask you what you've done and why, then you've got that answer ready, and it's a non-issue from your audit perspective. So a couple of recent developments, again, tying into the business, non-business apportionment. The test that HMRC applied to determine whether an activity was business or non-business traditionally came from the Lord Fisher case, which you may have come across the 6 questions. Is the activity a serious undertaking earnestly pursued? Is the activity an occupation or function actively pursued with a reasonable or recognizable continuity? Does the activity have a certain measure of substance? And that's looked at on a quarterly or annual sort of basis. Is the activity conducted in a regular manner and on sound and recognized business principles? Is the activity predominantly concerned with the making of taxable supplies to consumers for consideration? And this was always the kind of sticking point for academies and not-for-profit organisations, which often have a predominant concern, which is much wider than the sort of individual supplies or activities that they're engaged in. And other supplies that are being made of a kind which, subject to differences of detail, are commonly made by those seeking to profit from them. So yeah, in traditional VAT style, not very straightforward or particularly usable. But HMRC have, as I say, recently changed their policy. There's a number of cases, culminating in a Wakefield College case, and HMRC have refined this down to a two-stage test. And this asks whether the activity results in the supply of goods or services for consideration, and the supply is made for the purposes of obtaining income from it. So what is the perfectly valid question that you may be asking yourself, and hopefully not, why am I still here? But anyway, the difference with the new test is that every activity is very much considered in isolation. And HMRC's guidance has said the overall aims of an organisation hold no sway. So they may be looking to review the business, non-business apportionments on a much more granular level. And we have seen this in some sectors. So, for example, we've seen it with car parking. They're not looking at a contract to supply parking services for one organisation. They're looking at every single car park under that agreement to say, is this car park operated on a business or non-business basis? So it's something that they may be looking at again. Sorry. So from our point of view, for academies, this may also be an opportunity to review some of their activities. I mean, we think the second point is likely to be most relevant, and it's kind of what comes first in your decision-making process is going to be determinative, and that's the desire to make the supply or the desire to generate the income. So I guess the questions to ask yourself is your priority to provide this service, and you subsequently consider how this might be funded, or, and I think this is less likely in the context of academies, do you set out with the intention of generating some income and then lay on some activities to achieve that aim? So I suppose the distinction is the second point may be if you're looking to fund a trip and you lay on a different activity just to raise funds for that, it might be that kind of distinction. But we very much see this new guidance as an opportunity to revisit any business, non-business decisions you've made. And in particular, if you've had a ruling from HMRC where they've said, you know, this is a business activity and you're not happy with that, then this is, in our view, an opportunity to go back and say, well, the policy's changed, the test has changed, and we think, you know, what you said previously was incorrect. So if you are kind of saddled with a decision from HMRC that you'd rather not stick with, then, you know, we do have an opportunity here, as I say, to potentially revisit it. Okay. So the other sort of development that I wanted to mention today is towards the end of 2021, HMRC sent out a letter to many, possibly all academies that were not currently VAT registered. This looked very much like a nudge letter, which is HMRC trying to encourage compliant behaviour when they've seen recurring instances of non-compliance. The nudge letter, as it were, has come from other areas of HMRC activity where they've been trying to lead people back to the path of righteousness in respect of kind of tax avoidance schemes. But it's very much a nudge because people respond better to that than direct threats. HMRC or the government more widely has got a team of people called the Behavioural Insights team that sort of draft letters to try and provoke a response without sort of dictating it to it. So it's all based around some research, and if you're interested in how HMRC might be trying to manipulate you, there's a very good book called Inside the Nudge Unit, which is worth a read. But if you are a little bit paranoid about the state trying to control your life, don't read it. It will not make you feel good. Okay, so in these nudge letters, sorry, going off at a tangent there, they gave the example of the Cycle to Work scheme and childcare vouchers being business supplies, so any associated VAT can't be recovered under the on the VAT 126 under the special refund scheme. Now, what was quite telling for me, because bickering with HMRC, which I've done for a living for quite some time now, is it all comes down to the very specific wording. They gave the examples of Cycle to Work scheme, childcare vouchers, and other supplies, which is kind of everything that we're kind of interested in but not prepared to tell you about today. And that kind of makes me a bit nervous because HMRC do use nudge letters in quite an aggressive manner. So the letter may be drafted as a helpful little reminder, but, you know, to use their own catchphrase, if it seems too good to be true, it probably is. And this type of letter is often followed up with a campaign of VAT inspections in the sector that's received the letters. And if as a result of those inspections any errors are found, HMRC's starting point is, we advised you of the risk, we told you how to correct any errors, therefore any ongoing or uncorrected errors must be deliberate. And the reason they do that is it takes you into a whole different level of the penalty regime, and it puts you very much on the back foot because you're essentially defending yourself against an allegation of improper behaviour, when in fact it may be a relatively minor error. So it's just one to be aware of. So particularly in the context of those letters, the VAT at stake may be quite low. You know, I don't know how big the uptake would be on your cycle to work scheme, but you know, even if there's relatively little VAT at stake and the admin associated with correcting it does seem disproportionate, if you've had the letter, you really need to address it. So just tying back into what Glenn and Andy have been talking about, and getting ready for your audit. From a VAT perspective, it's being realistic about the timescales that we have. HMRC response times have always been somewhat short of our expectations, and post-COVID they really are slow. So to give you an example, we submitted an error correction notice on behalf of a client on the 4th of March this year. The outcome of that would be a £300,000 payment to HMRC, but they've not responded or engaged with us on the matter at all yet. It's just so slow. So, well, I could do a whole presentation on HMRC response times and what constitutes a working day in HMRC. The key point for today is that working with HMRC response times, we can't reasonably expect to resolve any major issues that require HMRC input within the timescale of your audit. On top of that, VAT is transactional, so if you're making an error, there's a potential for every transaction to compound that error. So if you're aware of any VAT issues, or there's something just niggling at the back of your mind, you know, I really would encourage you to get in touch with me or any member of the CP VAT team before the audit team arrive. What we can do in advance of your audit, which is something we've developed over the various lockdowns, is a VAT risk assessment. Starting point being an online questionnaire, which highlights your sort of risk areas, and the output from that is then tailored to your requirements. So this could range from a sort of risk matrix that was similar to the one that you saw from an audit perspective, or we can do a full report all the way up to a full on-site presentation and training for the people within your finance team who are dealing with VAT on a day-to-day basis. I mentioned the VAT penalty regime in the context of the nudge letters, and seeking professional advice and going through a sort of a review process demonstrates that you take your VAT obligation seriously and you've taken reasonable care to ensure that your VAT affairs are in order. And you know, this puts you right down the bottom end of the sort of penalty scale, and in reality we'd be able to mitigate penalties in most cases down to zero or suspend the penalty, because you know, we've all got things that you need to be spending your money on. We don't want to be funding HMRC any further than we're legally obliged to. So I mean, assuming that you're on top of your VAT affairs, getting ready for the audit will entail documenting your business non-business apportionment, including a note of the key decisions in that process, documenting how you determine the VAT liability of any business supplies, and for those of you who are VAT registered, understanding your partial exemption calculations and annual adjustments, and show how any major changes in the operation of the Academy has been dealt with. So just to summarise, preparing for your audit is very much like you would prepare for a VAT inspection, and the questions in respect to everything you need to do is: what have you done, why did you do it, and what, if anything, has changed since that decision was made. And of course, the VAT team here at CP and Andy and the team are all here for you, so you know, don't stew on it. Just pick up the phone and we'll help you out. So I mean, that's all I wanted to say to you all today, other than, are there any questions? And if you've got anything that you think of later, or that little confession that you don't want to share with anyone else today, then by all means, drop me an email later.
So hi everyone, I'm Nathan, the Employment Taxes Director at Parry, and I've been here since April, really, and over the next 5 or 10 minutes, I'd really just wanted to give you a brief employment taxes update on some key areas that I thought it might be worth sharing with you. So the first one is off-payroll workers, which kind of ties into R35 and employment status, then national minimum wage, a brief overview of why that's always a key area, and expenses and benefits, employment tax returns, and just more generally around HMRC activity where we're seeing a lot more interest. So first up is the off-payroll workers, which is always a key area and quite topical. And this one was really more just a whistle-stop tour to kind of remind everyone of the reason why it is always a high-profile area and essentially where we got to where we are. So as a brief background, HMRC are always interested in where individuals are performing services and roles that are similar to an employee, and they go by different names. You have consultants, contractors, or even office holders. And the main reasons why HMRC are concerned how they're engaged is because if they're engaged through an employee, in comparison to when they're off payroll, it's likely they'll pay different levels of tax and national insurance. And the way they're engaged will ultimately determine whether that individual is responsible for the tax and the national insurance, or whether it is your organisation. So it's always quite important to kind of establish that earlier on. And the main change that we've seen happen over the past few years is that HMRC has changed who is responsible for doing that employment status assessment over the past few years. Most recently is April 17, when they said that if anyone is engaged through a limited company, the responsibility to do that assessment is with the public sector organisation. And then they gradually rolled that out to the private sector from April 21. So essentially, it's always now falls on the organisation. HMRC are intending to make changes to the way they approach employment status from December 23. I'm not expecting anything dramatic really, but it's one to watch out for over the course of time. So the main thing I want to leave you with on this topic is really just ask yourselves is how comfortable are you that your organisation has a process in place to identify and assess anyone who is engaged off payroll. If they're on payroll, then chances are it's pretty fine. But if they're off payroll, you need to be able to identify them and assess them to make sure that they are treated correctly. And the final point is, I just wanted to mention to also consider umbrella companies and agencies. So HMRC have recently released what they call a spotlight, which is where they focus on a particular area that they think is, I wouldn't say responsible for non-compliance, but they may be prone to non-compliance. And they focus on umbrella companies this time, where what they're really saying is if your organisation uses umbrella companies, which essentially where you outsource someone's employment to another company, is you need to make sure that that umbrella company or an agency is accounting for that income to that individual correctly. So yeah, first of all, you need to find everyone who's off payroll, make sure you can assess them, and then you can make sure you're treating them correctly. The next one I wanted to touch on is national minimum wage, and it's always a strange one because it's, I think from the outside looking in, it's quite straightforward. Is in simply you just pay someone more than the NMW, which is currently £9.50, and unfortunately, it just is never as simple as that. Most of the errors that have happened over the past few years are down to what we call technical breaches, which is where the individual was actually being paid more than national minimum wage, but because of other factors that came into play, the way the calculation is done, they're actually being paid less. And a typical example would be if there are any deductions from an individual's pay, for example, salary sacrifice schemes, or if they're working much longer hours than actually being paid for, that can also put them below national minimum wage. So it's definitely one to watch out for. And the penalties for NMW non-compliance can range up to 200% for any underpayment that's identified. So it can get quite sizable. And there is a maximum amount of that penalty for £20,000 per worker. So on the NMW perspective, it's more just making sure that the organisation has a process in place to identify any workers who may be at risk of being paid less than national minimum wage. Okay, I'll say the core category is anyone who is on a salary sacrifice scheme or anyone that earns even remotely close to NMW. Just have a quick look at them in a bit more detail to see if they're at risk of being paid under NMW. The next one I wanted to touch on was more generally around HMRC activity and expenses and benefits. Over the past, probably since we've came out of the lockdowns, we've seen much more activity from HMRC around general compliance, and that's HMRC going out doing what they call employer compliance reviews, where they essentially look at all areas of the business from a payroll perspective to understand if there's any tax and national insurance that hasn't been accounted for correctly. I'd say that the key topics that they're after is whether employees were provided with any equipment while they're working from home from the business and how that was treated, and more importantly, whether the employer actually get those back from the employees or let them keep them, whether individuals were given any gifts by the employer and what the reasons for that was and how that was treated, and also whether employees are reimbursed while they're working from home when they're required to travel to and from the office. And then you have other areas as well, such as staff entertainment, trivial benefits, and also salary sacrifice schemes as well, which Matt touched on briefly. And around that area, HMRC are always interested in to make sure that when a salary sacrifice scheme was put in place, was it actually valid? And usually the one thing they're looking out for is that there was a formal change to the terms and conditions of someone's employment. That's with that explicit agreement where they say, yes, I'm happy to reduce my salary in exchange for this benefit. And as always, HMRC are always very interested in any process around expenses and benefits, whether that's having a policy in place, in how you gather the data and information for the forms P11Ds, and actually just generally running the payroll. So the other question I would want to leave you with is have a think and how does your organisation ensure that all benefits that are provided to employees are treated correctly and more importantly actually captured so they can be considered. Just a whistle-stop tour of employment taxes. Hopefully we'll bring everything back up.